Thinking Byzantine here, and today we'll be talking about the S&P 500 Growth ETF, or SPYG. Now for a quick disclaimer, I am not a financial advisor and I'm just expressing my own opinions. Also, the information I will be using is from December 5th or before. Now let's get right into this. The methodology SPYG uses is that it chooses the top 300 out of the 500 companies of the S&P 500 based on sales growth, momentum, and ratio change to price. Here are the stats for SPYG. It was made in 2000. It has an expense ratio of 0.04, over $9 billion in assets managed, over $100 million in average daily volume, a current dividend yield of 1% or close to 1%, a current share price of $54.17, and the average annual return over the 5-year period is 17.49%. Here are the top 5 holdings of SPYG: Apple, Microsoft, Amazon, Alphabet, aka Google, and Facebook. Here are the sector weightings of SPYG, and as is no surprise, technology is at over 50% of this portfolio's sector weighting, due to the fact that technology has seen some good growth these last 5 years. And with that in mind, the other sectors only take up around 48.97% of this portfolio, with consumer cyclicals coming in second at 18.09, healthcare in third at 10.04, industrials at 8.07, financials at 5.59, consumer cyclicals at 3.84, basic materials at 2.21, utilities at 0.64%, and energy at 0.48%. Here are some alternatives to SPYG. We have VUG, which was made in 2010, with a higher expense ratio at 0.1, and an assets under management is at around $4.6 billion, which is less than SPYG. Average daily volume of around 25 million, which is less than SPYG. A current dividend yield of 0.89%, also less than SPYG. Current share price of $225.55. And average annual return over 5 years is 17.49%. 17.45%, sorry. Then we have IVW, the iShares S&P 500 Growth ETF. Also, it was made in 2000, an expense ratio of 0.18, also higher than the other two, SPYG and VUG. Assets under management is around 30 billion, more than SPYG and VUG. Average daily volume close to SPYG, a current dividend yield bigger than SPYG, current share price of around $62.51, and the average annual returns over 5 years is 17.54%. Now let's look to the charts to compare SPYG and the alternatives. Now we have VUG versus SPYG first, and you can tell that they have nearly similar charts. And I guess you can say SPYG wins slightly because of that expense ratio being lower. And here SPYG versus IVW. SPYG slightly comes out at top, barely. Also, I'm guessing it's because of the expense ratio being lower than the other two alternatives. And now, why would you want to invest into SPYG? Well, it's tech heavy, and it seems like tech has been doing well lately, and tech has been showing some resistance to COVID. And their methodology is pretty good, in my opinion. I like how they're choosing companies based on their growth, and it has outperformed SPY these last 5 years. As you can tell from this chart, you can see that SPYG is beating SPY by around 4-ish%. Now, why would you not want to invest into SPYG? Well, it's tech heavy, and being tech heavy is a double-edged sword, in that some people think that tech at this time is very overvalued, and tech inherently doesn't have a really big dividend most of the time. Also, interestingly enough, SPYG actually loses to SPY on the 20-year timeline. As this chart can tell you, see here, and if we look at these numbers here, you'll notice that SPYG's average annual returns over the 20-year period is around 0.5% less. This tells us that SPYG performs well in times of great growth, and SPY outperforms SPYG when the markets were a bit more stagnant and there was less growth. So I'm guessing from the period of around 2000 to 2010, where the US market wasn't growing as fast as it is compared to now. And like and subscribe for more content like this. I would really appreciate it.